Do you want to lose half your wealth in a market crash? Or do you want stable returns while managing risk? Want to know the asset allocation principles the wealthy actually use? The answer is simple. Combine stocks, bonds, and cash. Rebalance once a year to maintain your target allocation. Why does this work? This slide explains everything. The 60/30/10 allocation. This is one of the proven strategies. 60% stocks is your growth engine. High returns expected over the long term, but volatility is significant year to year. 30% bonds provide stability in most scenarios. They cushion the impact when stocks fall. 10% cash equivalents ensure liquidity, the buffer that keeps you from selling investments during a crash. This allocation has been validated by decades of data. This isn't theory. This is a strategy countless investors have tested and proven effective. And this is achievable. Open a brokerage account. Allocate across stocks, bonds, and cash. Adjust based on your situation. Now your wealth follows a strategic blueprint. Today, I'll show you the principle. If you're 30, the 120 minus age rule gives you 90% stocks. If you're 50, 70% stocks. If you're 70, 50% stocks. This is the 120 minus age rule. Subtract your age from 120. That number becomes your stock allocation guideline. At 30, 120 minus 30 equals 90%. At 50, 120 minus 50 equals 70%. Remarkably simple, right? This is an aggressive allocation example adapted for modern longevity. Want to be more conservative? Use 100 minus age instead. Why did this approach gain traction? When you're young, you have time. Time to recover from market crashes. So you can maximize stock allocation and prioritize growth. As you age, time shrinks. Stability becomes critical. That's when you increase bond allocation. But this is a guideline. The right answer depends on your financial situation and goals. Income stability, emergency fund, debt, when you'll need the money. Factor in everything. This rule embeds your life's time horizon into your asset allocation. Not emotion. Planning. 100% stocks offers the highest expected returns. Sounds attractive, doesn't it? But the volatility is extreme. One year up 30%, another down 20% or more. Can you stomach this roller coaster? Look at the 60/30/10 allocation. Generally, reducing stock allocation and adding bonds and cash tends to lower annual volatility, standard deviation. However, the exact numbers vary by country, time period, bond duration, and rebalancing conditions, so grasp this as a concept. Financial markets have an iron law. High returns always come with high risk. Zero risk with maximum returns doesn't exist. That's why we seek the optimal balance between return and risk. In mean variance theory, diversification moves you toward a more efficient frontier. But optimization is sensitive to assumptions, so don't treat any specific ratio as a universal optimal solution. You should choose the option that lets you sleep soundly at night, even if it sacrifices some return. Historically, stocks and bonds have tended to move differently. When stocks fall, bonds sometimes rise. That's why bonds tend to enhance portfolio stability. But there are exceptions. Remember 2022. Inflation and rapid rate hikes happened. What occurred? Not just stocks, but bonds fell sharply at the same time. The year traditional 60/40 allocations faced a real test. So bonds equal always safe is wrong. The realistic approach includes bond duration and inflation protection in your design. How diversification works changes with interest rate and inflation environments. But here's the good news. With recent interest rate normalization, bonds have regained appeal not just as cushions, but as assets generating reliable interest income. The zero-rate era is over. We're in an era where bonds deliver income again. Still, the risk is lower than single-asset portfolios. Not perfect, but a better choice. Say you started with 60/30/10. A year later, stocks rallied and now represent 70%. What do? Rebalance. Sell stocks back down to 60%. Buy more bonds and cash. You're selling high. Conversely, Stocks crash and drop to 50%. Buy more stocks back up to 60%. Sell bonds and cash. You're buying low. This is annual rebalancing. Sell high, buy low. Automatically. Not emotion. System. What's the primary purpose of rebalancing? Returning your risk level to the original target. Maintaining the allocation you designed. That's the first priority. Vanguard research shows that maintaining proper asset allocation and preventing emotional trading, behavioral coaching, can boost effective annual returns by approximately 1.5% or more. This isn't about timing the market. This is about maintaining discipline. The effort varies with the number of accounts. To minimize taxes and trading costs, you can also restore ratios through new contributions or adjust within certain deviation bands. Rebalancing is systematized discipline. Once a year, you honor your plan. That generates long-term success. Nobel laureate Harry Markowitz's modern portfolio theory formalized the power of diversification. The phrase goes, "Diversification is the only free lunch." Why? There's a concept called correlation. A correlation coefficient of plus 1.0 means perfect synchronized movement. 0, diversification benefit. 0.0 means unrelated. Moderate diversification benefit. Close to minus 1.0 means inverse movement. High diversification benefit. However, combining assets with low or negative correlation tends to reduce risk. But it doesn't reach zero, and correlation itself shifts across market phases. During crises, correlations can spike. Still, combining stocks, bonds, and cash generally reduces risk compared to single assets. Not perfect, but a better choice. Diversification increases probabilities. Not guarantees, but it's the best way to increase the certainty of wealth. Betting on one asset is gambling. Diversification is science. So how do you actually implement this? 5 steps. Step 1. Set your goal. Be specific. $1 million in assets by age 50. Without numbers, there is no plan. Step 2. Assess your risk tolerance. When the market crashes 30%, can you handle it? Or will you panic and sell? Answer honestly. This determines your stock allocation. Step 3. Decide your asset allocation. Use 120 minus age as a baseline. If you're 40, start with 80% stocks and adjust based on risk tolerance. Step 4. This is critical. Before investing, secure 6 months of living expenses as an emergency fund. Liquidity comes first. Then allocate within your investment capital. Open a brokerage account and start automatic contributions at $500 per month. For example, stocks in a global equity index fund, bonds in a fund, matching your objectives. Cash equivalents? Not just bank deposits. Hold them in yield-bearing money market funds or short-term treasuries, the way the wealthy do. To protect your assets from inflation. Step 5. Rebalance once a year. Do it on your birthday. Easy to remember. Maintain your target allocation. These 5 steps are your wealth blueprint. Now let's consolidate today's key points. Here's the summary. First, the power of asset allocation. The combination of stocks, bonds, and cash. 60/30 is one proven strategic example. The optimal allocation varies by your goals, time horizon, and risk tolerance. There's no single answer. Find your answer. Second, the essence of rebalancing. The primary purpose is restoring risk to your original level. Annual discipline prevents emotional trading. Maintaining proper asset allocation and behavioral coaching drive long-term success. System beats emotion. Third, the principle of diversification. Combining low correlation assets tends to reduce risk. Not perfect. The effect varies by market phase. Still, a superior choice to single assets. Diversification is science. Betting on one asset is gambling. What's your current asset allocation? Are you taking too much risk with 100% stocks? Or missing opportunities with 100% cash? What's your next step? Securing your emergency fund first? or rebalancing your current portfolio? Share your strategy in the comments. Your asset allocation, your questions, your success stories. All of it becomes this community's wisdom. Thanks for investing your time with me today. This channel delivers actionable strategies for asset allocation, risk management, and financial freedom, backed by numbers and principles. You can implement strategic wealth building too. Subscribe and gain deeper insights in the next video. Turn on notifications. See you in the next one.